What happens if your employer withholds too much income tax from your fortnightly pay? One of my regular viewers of Money with Dan and a loyal subscriber recently asked me this question. The short answer is not much. Until at least the tax year ends and you lodge your income tax return. However, there is much more to understand about how Australian income tax works if you're new to working in Australia, and I'm going to explain in a way that's easy to understand. If you want to avoid paying too much tax, then you need to watch until the end of the video to learn when and why this could happen to you and how you can avoid it. Skipping through just one point in this video could lead to a misunderstanding, so please watch right to the end to make sure it makes sense. If you pay too much tax, then you are essentially giving the government an interest-free loan for the government to benefit from, while you don't benefit at all. You will also not be paid any interest income on the amount of tax you have paid while the government holds onto your money. So you really need to take action to claim back your money as soon as possible, and there's a simple way to do this. The way that you need to claim this tax back requires no extra box to tick and no extra answers to complete. You just need to simply prepare your tax return as soon as it is due and either lodge it yourself on the MyGov website or pay a registered tax agent to prepare and lodge it for you. Sometimes that extra tax may be helpful if you haven't paid enough tax on other income from other sources like interest or dividend income or selling crypto investments, for example. When this happens, your extra tax is used to offset tax earned from those other sources, so you avoid getting a dreaded tax bill when you lodge your tax return. There are no penalties for paying too much tax and very little upside to doing so for most people, but people still sometimes pay too much tax. Why would anyone pay too much tax? Well, it happens quite often, and usually it's by taxpayers who have variable salary and wages, who work casual or temporary jobs. Other times it happens when a taxpayer's circumstances change, and sometimes it happens by mistake when not completing certain forms at the right time, like a TFN declaration. For instance, if you worked more hours than usual at your existing job and got paid more during a fortnight or month, then your employer may have to withhold tax at a higher marginal tax rate than normal. A marginal tax bracket is simply the different percentage of tax that you must pay in Australia if you earn a certain amount above the levels that are listed. If you earn less than $18,200, then you pay no tax at all, which is the tax-free threshold. So most low-income earners who work casual or temporary jobs pay no income tax, or very little, which is quite fair. The amount that is withheld from your take-home pay is calculated on assumption that you would earn that income every fortnight during the entire year, and you would reach a certain annual income if you continue to earn that same amount every fortnight or month, which doesn't usually happen for casual or temporary staff with income that fluctuates up and down. If that annual income level is at a different marginal tax bracket, then the extra income you earn would be taxed at a higher tax rate. For example, if Jim normally only works 4 weekend shifts of 8 hours per fortnight at McDonald's for most weeks of the year, his fortnightly income would be $576 if he earned $18 per hour at 8 hours for 4 shifts before tax. If he only works these hours for the entire tax year, then his projected annual income would likely be $14,976 or $576 times 26 fortnights, assuming he has no other jobs or other income. As Jim's annual projected income is less than the current tax-free threshold of $18,200 per year, then his fortnightly pay would have no income tax withheld by his employer, McDonald's, who would later pay this tax to the government on his behalf, as required by law. Now let's say that in only one fortnight Jim works an extra 3 8-hour shifts as he has some spare time and the restaurant is short-staffed. Jim's income for this particular fortnight is now $1,008 for the fortnight. Jim's projected income is now recalculated, and based on this fortnight income, he is now projected to earn a whopping $26,208 per year. As his projected income is well above the tax-free threshold and well into the first marginal tax rate, McDonald's would withhold about $58.25 of Jim's pay in this fortnight and pay him the difference of $949.75, which is $1,008 less the tax of $58.25. If you think this amount of tax is too high and you won't earn that much for the full year, then there is very little you can do to stop your employer from paying this tax at this point in time. Now, if Jim goes back to working his normal 4 8-hour shifts per fortnight and never works any more shifts for the rest of the tax year, his actual annual taxable income would only be $15,984, which is $14,976 plus the $1,008 for that shift, with $58.25 of tax tax having been withheld from his pay packet in total for that one fortnight he worked those extra shifts. This is because his projected income will drop back down in the following fortnight back to his normal level, which would once again be under $18,200, or the tax-free threshold. Jim would have been taxed more than he was required to for one fortnight only, and he would likely be owed a tax refund when he lodges his income tax return for that year, assuming he had no other income that was not taxed. The only way Jim can get the extra tax refunded back to him is to lodge his tax return as soon as possible and get that money refunded to him, which is normally 14 days after you lodge your tax return. Sometimes it's a little bit earlier. This example also applies to people moving up into higher marginal income tax rates by working extra hours regularly, getting a pay rise, or receiving an annual bonus if you're lucky enough. Some people mistakenly believe it is not worth working more hours, getting a pay rise, or a bonus if you're getting taxed at a higher rate, since your take-home pay is disproportionately lower once you move into a different tax bracket. However, these people don't understand that if they pay too much tax than required, they would be paid a tax refund at the end of the tax year, and don't take that into consideration. In my opinion, it is always best to earn more money when it's available, if you can, and don't worry about the tax implications, as it will sort itself out when you lodge your tax return. You will pay your fair share of tax in Australia by the time you lodge your income tax return, and a tax refund corrects any overpayments, even if you think your employer is taking out too much tax from your fortnightly pay packet at the time. Other reasons people pay more tax include not completing their TFN declaration accurately at the start of the employment, or forgetting to update the answers when their circumstances change, such as whether they're claiming the tax-free threshold or not when you were working a second job and then switching jobs entirely. When can you lodge a tax return in Australia to get your extra tax payments back? Before I explain this very important step, please remember to hit the like button if you found this video helpful to support my channel, and also subscribe for more videos from me to share ideas on how you can save more money, especially at tax time. The earliest time you can lodge a tax return in Australia is around the middle of July each year, and it covers income you were paid for the previous 12 months between 1 July of the previous year to 30 June. So if Jim, from my earlier example, had too much tax withheld from his wages paid on the 10th of July 2022, he won't be able to get a refund for that extra tax until the tax year ending on the 30th of June 2023. That is because the salary he earned was paid between the start of the tax year on 1 July 2022 and the tax year ending on 30 June 2023. It is a long time to wait for a tax refund, but you will get your money back eventually, and delaying your tax return being lodged only lengthens the time it takes to get your money back. It's always best to avoid the situation of paying too much tax if you can, and making sure you complete an accurate and up-to-date TFN declaration with your employer, and also completing a super choice form when you start a new job are two great ways to save on fees and taxes. The two videos appearing on the screen right now will walk you through how to complete each form step by step while explaining what each question is requiring from you and why it matters. See you in the next one.